Okay, this is another live underwriting session. The park at Ashley Place. I believe this is a 143 unit apartment complex up in Pasco County, Newport Richey to be exact. I believe this may be a B area. So we're just going to kind of scroll through the OM here and gather up some notes. I'm going to pause for a second so I can grab my notepad and jot some things down along the way. So bear with me here. As you know, underwriting deals the effective way may take you anywhere between 60 to 90 minutes. Could even be longer than that, depending on how big the deal is when you're looking at comparables and things of that nature. So you got to have a love for numbers, a love for being analytical in order for you to be successful at underwriting these larger deals. So just gathering up some paper here so I can take down some notes. Actually going to, this is the park at Ashley Place. Newport Richey. 143 units. All right. This probably is not going to come with an asking price. These are all the listing contacts for the property. This is a beautiful marketing brochure, which they call offering memorandum. So yeah, 143 unit multifamily community located in Newport Richey. Kind of gives you an overview here of the property. So investment highlights. Anytime we get ready to underwrite a deal, we want to come to the OM and just kind of see what they want to see, what the brokers are saying about all the highlights of the property. So it's a Class B garden style apartment community, which we do love Class B and C. Ability to increase average rents by over 200 from the current in-place rents. Okay, so they're saying this is some value add. Further upside by continuing to implement the current $60 cable and internet charge on the remaining 129 units. So that's something that we definitely want to take into account. Well located near Little Road with 44,000 vehicles per day, so that means that it has high visibility. It's right off a main road, just a 30-minute commute to your neighboring MSA, which is Tampa. Minutes from A-rated Trinity Hospital, which is good, over 1,400 employees. Pasco County has experienced exponential growth and new developments for office, industrial, retail, single-family home communities. High impact value upside. So we want to just kind of read through this. Based on current market competitive set analysis, a value add program will allow monthly market rents to be increased by an average $212 per unit. The cost of the updates is estimated to be $4,500 for one bedroom floor plans that do not have washer dryer connections, $5,000 for one bedroom floor plans that have washer dryer connections, and another $5,000 for two bedroom floor plans, and $1,000 per unit for exterior enhancements, resulting in a potential increase. And it kind of goes over some of their listed interior upgrades that you would want to do in order to achieve those $212 premium rents. And how they gather this information, they kind of see what's going on with the competition, you know, what they're getting for rents and the amenities that are located inside of their apartment community. And so this is what you would have to do, or kind of give you an idea of, you know, this is what you need to do in order to raise those rents. So as you can see here, very basic, very basic, outdated, uh, outdated kitchen here. So it's kind of letting you know what you should put or what you should install as far as amenities. And this is what the competing properties look like in the area. So we definitely want to bring that up to par if we can. Okay, this is the fitness room. Okay, this is palms, the promenade, the pool. All right, and so here is our apartment complex. All right, that sits right by a fitness center and self-storage. Property descriptions: built in 1986, 143 units, 2 stories, occupancy 98%. It's made out of concrete block stucco. And it goes into a little detail here about who the electric is provided by, cable, water, sewer, and here are all the fees that they're charging monthly. So this would be added into the other income category, and we'll get into that. Again, here's the apartment home features. Not bad, but still some upgrading needs to be done here. Okay, just kind of let you know what you need to do with the kitchen, what you need to do to the bathroom, so forth and so on. So we're going to keep scrolling past this, and I just kind of do this to get an overview of the property, of what it may look like. But seems like a very nice property. They got a fitness center here, which is pretty cool. Here's the overall site plan, floor plans. Here is some of the employers in the area. Okay, there's a lot of construction going on in this particular area. Here's a lot of retail. Here's our apartment complex that sits right behind this retail shop, which I think is pretty cool. Here's the pool area. Starts to talk about, Tampa Bay as a whole, which is a great market to be investing in. Goes over some of the demographics here. Talks about the education and the medical, heavy in the medical industry in this particular submarket. Here's all the retailers here in this submarket. Some of the tourist attractions here. Just kind of let you know all the schools that are in the area. All of them are A-rated schools, so it says a lot about the community. 5 minutes from the place, from the community. So it looks like a fairly nice community. The question is, what are they going to actually ask for rents? So here you're going to find 1-bedroom apartments, 2-bedroom apartments. So just follow my cursor as much as you can. Right now, the market net rent on 49 of the 1-bedroom, 1-baths that they have, okay, are at $777. They're saying that we can boost that once we renovate it to $925. Okay, and then we have 46 of the 1-1 renovated that we can boost to $975. Okay, all right, and so what we're gonna do, I'm just gonna jot that down here. So anytime I come to this portion, and this is just what the brokers are projecting. So at the end of the day, you got to do your own market research. Maybe go to Rentometer, Craigslist, even call some localized property managers in the area, or even get your property manager to kind of run a market analysis for you to see exactly what you should be paying in rent, or what you could possibly get in rent bumps if you were to implement your value add plan. So I'm just going to write some of this stuff down here. Matter of fact, let me scroll to see if they got it anywhere else so I can see that, and they probably will too. And then we'll scroll back up and maybe kind of look at, yeah, they do. And we'll kind of scroll back up and look at some of the comps that they have here. So I'm just going to write down, I always write down the unit count, the unit mix, the square foot of that particular unit, the average rent. Well, we don't want to do the average rent. I take the market rent down and also take the renovated rent. The renovated rent is just a pro forma what they're selling on. Again, you got to get confirmation that you can actually boost this. In the B class market, I don't see why you can't get this. This definitely seems a little low considering the area. This may be a B property in an A area. It's just neighboring Tampa, so let me go ahead and write 49 1-1s. We got another 46 1-1s with washer dryer connections. Washer dryer, square feet, 700 square feet. We're gonna write down 48 to 48 to twos. Washer dryer connection, square feet 950. And then we have market rent. Let's just put effective rent here. So we have market rent at 777, 982. And then we have our Reno rent at 925, 975, 1175. Okay, all right. So we have 3 available units. So we have 3 units vacant. 3 units that are vacant. So 97.90% occupied. And we'll do some calculations on the rental rent. So usually what I do here to kind of get a pro forma of the annualized GPI, what we can pull per year GPI is just gross potential income. I take 925, so I'm going to pull my calculator out here. This is something that I'm doing off the screen. So you want to make sure that you have a calculator nearby, pen and pad, so you can take some notes. So I'm just going to take that 925 and then times it by 49 units. And we have 45 through 25. 45 through 25. Okay, and we take that 975 times 46 units. We have 44,850. Then we take that 1175 times 48 units. And now that we have our numbers there, we're just going to add all 3 of those numbers up. 56,400 plus 44,850 plus 45,325 equals 146,575 that we can pull monthly off of pro forma. That's what they're saying. We still got to confirm that. We want to annualize that number out, which comes out to 1,758,900. So 1,758,900 is the pro forma GPI. Okay, so we always want to get that written out. And now let's scroll back up here and just kind of check out some of maybe the rent comparables and the sale comparables in the area. And we can also do that right here too as well. So this is all the properties that they're listing as rent comparables and sale comparables. Sawgrass Creek, I don't think would necessarily be too comparable to this. It's only 9 units and it's built in 2015. Our place is built in 1986 that we're taking a look at. So everything else on here, for the most part, just seems like it may be comparable. Let me see here. And so when we look at the square feet, that's what we want to do first. Just kind of look at the square footage. As you see, we do have some of the bigger units as far as 1 bedroom, 1 baths, but we're only commanding $777 in rent. All these properties are nearby that are competing with us. They're commanding. You got Promenade, was commanding $858 on the average for their 1 bedrooms. You got Cypress Trail, 120 units. Their one bedrooms are smaller. Seems like the majority of them are compared to ours. They're commanding 900 in market rents. Let's take a look here at the two bedrooms. We got 950 square feet. Uh, and so we're above the average here. Okay. We're right about average here for the one bedroom. So we're above the average, which is pretty cool for the area. So there more than likely is an opportunity to boost that rent there quite a bit. And so let's take a look here more at some of the square footage of these properties. So we got a 2-2 that's renovated. They're commanding 1,062 in rent. Here's a 2-1 that's renovated, but it's built in 2002. So let's kind of stay within the 80s if we can. That's a small 2-bed, 1-bath. This would be comparable. Palms at Wintry. They're commanding 1,095 in rent. So there's some possibility too. Also, when you're looking at these comparables, you want to look at the utilities included in the rent. That definitely plays a factor into how much you can actually charge. And so T means trash. They're charging none here. Let's see, includes. Okay, so they pay for everything, water, sewage, and trash. It's included here. It's included here. So you gotta really get a feel for the competition of, how much, what are they charging their tenants? Are they, is the water, sewage, and trash included, in the rent? If so, you got to take that into consideration, um, and maybe you can get a higher bump in rents. But if not, then you more than likely have to figure out how you can stay competitive somehow. But right now, we are not charging our water, sewage, and trash is not included in the rent, which is cool. The tenants are taking care of that, so that's pretty awesome. So let's look at some of the rent comparables. Here's our property here. Okay, we know that we got 700. Just kind of going over some more rent comparables. $1.11 per square foot. You want to pay attention to this number. How much per square foot these units are renting for, and then compare them to other properties and see that I don't think this would be comparable at all. This is a property built in 2015, Class A property, right out of the ground. I don't even know why they would, compare that to ours. This is something that would probably be maybe a little more comparable. Just 288 units. You kind of see what their properties look like on the inside. It has a nice pool here, Palms at Wintry. You see what they're commanding in rent for all their renovated units. So obviously, an investor came in here and implemented a value add program and executed on that. Now they're getting market rents. Here's a property right here that I think would probably be the most comparable, built around the same year. This is what they're commanding in rents. With their particular properties, our 2-bedroom, 2 baths, theirs is 902 square feet. Ours is 2 bedrooms, 2 bath, 950 square feet. And we're commanding 982 in rents. We should be getting somewhere near 1,200, just as these guys are getting right here. Okay. All right. So that's a really good key indicator that there's probably some value to add. What they're looking to get in price is probably going to be the ultimate factor. So this is another property that's very comparable. Looks like they got new kitchen, stainless steel appliances, resurfaced countertops in here. Their 2 bedrooms are at $975. They're charging $1,062 for rent. And they have some little larger bedrooms there too as well. Okay, and so just kind of taking a look at some of the properties here. Here's another one. I feel would probably be most comparable. It's 95 units. Here's a 2-bedroom, 2 bath. They're charging $919. That's the market rent for this particular place. Okay, they're billing back the water, sewage, and the trash, so they're recapturing on that expense. Here's a little outdated property here. Ranch side, built in '89, 76 units. They're 2 bed, 2 bath. They're commanding 901 for 864, but it needs an upgrade. Let's go back up here really quick to ours. Okay. All right, 982. I just wanted to kind of get an idea. 982. Okay, so you got to be able to compare these properties. Again, we got to get boots on the ground and make sure that we're mystery shopping all of these properties in the area. We may want to mystery shop at least 3 to 5 properties so that we can get an idea what type of amenities these properties are offering and why they're able to command market rents, and see what we need to do to our property based on what the competition is doing in order to bump those rents. Here's, I believe, some sale comparables. Got 240 units here. This just sold back in September 2018 for 26 million. You got Four Lakes right here, 295 units, sold at 56 million. Let me see here. Just want to kind of get an idea. 56, 250 divided by 295 units. They're charging like 190,000 a unit. I think that's absolutely ridiculous. Oh, it has it right here for me. What am I doing? I did that calculation on my calculator. I think that's ridiculously high for the area. And so now we're going to get into some of the financial analysis, or better yet, the value add analysis. I rarely underwrite using the OM, although we can take these figures and put them into our syndication model. Tend to want to do the T12 and the rent roll first. All right. Have a great day. Love you. Have a great day, Sid. Bye. All right. So excuse me, guys. I'm saying goodbye to my family for today. So back on track here. They're saying for the most part we need to bring about 6,000 per unit. I'll bump that up to 6,500. Then we're going to add another 1,000 for reserves, so 7,500, plus another 1,000 for 1 month's rent, just in case we experience some dip in occupancy, which we probably will since we're coming in with an aggressive value add plan. So we'll be at roughly 8,500 per unit for CapEx. Let's just plan that until we can get more of an idea. We get on site, so 8,500 times 143. You want to do that calculation. Which is 1,215,500, and this is the amount of capex plus plus reserves that you want to bring to the table. 1,215,500. Okay. Notes and assumption. Just kind of tells you, why they underwrote the way they did and what they took into account as they were underwriting the deal, the brokers. But this is the, I don't know what you want to call this, the leasing office or chill spot where the apartment complex is located. Okay, so they don't have that in there. Okay, so let's do this, man. Let's get right into now the T12, the trailing 12 profit and loss statement over the past 12 months. And as you start to study, let me see if I can blow this up a little bit more. Okay, as you start to study this profit and loss sheet, you want to go through every month and really just kind of see, if there was a big dip in, in revenue collected. So here we got revenue here at 104 for February 2018, March 18 we got 111. We had a little dip here in April, started to decrease again, or went up a little in May, decreased quite a bit in June. We need to figure out why that is the case, because of looks like we had quite a bit of a vacancy loss, and then we have some employee units. Employee units probably means employees live on site and they have some sort of deduction in their rent. Here we're creeping back up, and here we're back down again. Here we're up, we're down, up, up, and so we're up for the last 2 months. So um, generally, you may have that from month to month, but we want to experience more up months than down months and more consistency of going up. So management can probably be tweaked here. For the most part, this is all on management at the end of the day. And so what we want to do now is just go ahead and start plugging some of this stuff into our underwriting model. Okay, so this is a T12 February 2018, January 2019, right? So we're going to label this scenario. And with the software, we have 4 scenarios that we can create, actually 8 scenarios if we click on that. So to minimize that, we just come back here. We can run different scenarios to see, how, if we were to do this or that to the property, this is what the numbers would look like. So this is what's pretty cool about the program. They're not giving us any asking price, so we're going to have to kind of really figure out, what we should be offering, and you'll see how to do that here. So let's get into compiling the revenue here. All right, and let's go to market rent gross possible. Let me see something here. Okay, so we have market rent. Okay, so we have 1415984. 1415984. We have 143 units. Okay. Let's go back over here, and we have a loss to lease, right? And so what we want to do, we want to add that. We want to take our concessions, because all that will be in one line item. Highlight that. We want to have our bad debt, right, in one line item too as well. Okay. We're going to have our bad debt recovery, which is a debt that we've recovered from tenants moving out. We got some employee units that we need to take into concessions too as well. So we're going to take these highlighted blue areas and add them up. Okay. What you see in parentheses is actually a loss, and what you don't see in parentheses is positive. Okay, so this is recovery down here. So I'm going to take our calculator here. Let's see if we can just pull it up here. That wasn't a smart thing to do, so let me go back and highlight that again so you guys can keep your eyes fixed on that. And so we'll just do it on our phone here. Okay, we have 42,725 plus 761 plus 3720 plus 10398 plus 25, 7260. So we have 177 for our concessions. We don't want to go and put that number in there, right? We want to take the 177 and divide it by this number, right? So we're going to take 177 and divide it by 1415984. Okay, which is about 4%. All right. And so we're just going to come and put 4% there. Okay. All right. And so we boost that up a little bit. to maybe say 4.5 so we can get to our 60, or 4.2. Let's see what that looks like. All right, that's close enough. And let's see if we can get 4.22, what that looks like, or 4.25. We just want to try to get it as close as we can to that 60. There we go. So that's perfect. That's right on point. All right. Then we're going to come back over here, figure out what our vacancy is. Our vacancy is listed right here. Our vacancy lost. Okay, so our vacancy loss is 37,252. So 37,252 divided by, I'm doing this off screen. Okay, 37,252 divided by 1415, 984. Okay, so we're looking at about maybe 2.7% in vacancy. Yep, that's close enough. All right, now we have our my version over here. Our standard rule of thumb is to factor 10% vacancy in to stay conservative with our underwriting. And now we're going to figure out what our other income is, right? So here's the other income line right here. We'll highlight that. Okay, and now we're going to figure out all of our other income, which they have done here. For the most part, it includes application fees, cable revenues, damages, eviction fee reimbursement that they got back from tenants, interest income, late charges, all this other stuff here is total other income. And so we're going to highlight this field and go with this number. This is the total number at the end, 93,838. 3,838. Okay. Now another thing, when you're underwriting deals too, you want to take a look at, late charges and lease termination fees, and if you're collecting a lot of money every month in late charges, and you're doing a value add program, and you plan on increasing or bettering the tenant profile there. You're looking for a different tenant profile, a better class of a tenant, then your late charges are going to go down. So your other income may be higher in the T12 than what you would actually do with other income, because you're actually fixing a lot of the problems. You're repositioning the property. You're attracting a new tenant base where you're not going to have to worry about collecting late fees and things of that nature. So when you're underwriting, you got to take those things into consideration. Okay, so we got a utility reimbursement program. Okay, what this means is there's some type of RUBS program in place, ratio utility billing system, to where they are now charging the tenants a percentage of the bill back. So they're recapturing that. We can also use that as other income too as well. So let's do that. Let's add this 34,000 to this 93,000, right? And then we'll put that inside other income. 838, 8 plus 34, 072, 61. Okay, so we're at 920, 127, 911, 127, 911. And our total net income is 1,445, 484. Let's see what the okay, so we're close. They have it at 1,451,610. Ours is at 1,445,484. When you're dealing with numbers this large, you're not gonna have the same exact numbers as the T12, but you want to be in the same ballpark, because this number compared to this number, although it is slightly different, it's not going to make the world of difference when you're dealing with numbers as large as this, as far as percentages wise goes. Okay, all right. So now what we're going to do, we're going to get into the expenses, right? We went over we compiled the total revenues. Now what we're going to do, we're going to do the operating expenses. So let's highlight that. The first one that they have going here is the payroll. And so we want to calculate the total payroll. Okay, total payroll and benefit cost. Okay, total payroll Okay. Total payroll and benefit cost. Okay, so let's just do that because they compiled it here. So we'll just take this number, the 201. What they did was add this 41,000 to this 160,000 right here, and they got 201. So we'll put 201, 349 down into the payroll. So here you're gonna see your expenses here. Okay, and now we come down to payroll, 249, and we're just gonna input these numbers. 201, 349. I'm sorry, 201, 349. Okay. Let's go ahead and put about maybe 300 per unit as far as our replacement reserves. All this is when you get ready to turn a unit and release to someone else, you're going to have some expenses there. Usually it's just cleanup type stuff. You want to make sure that you factor in maybe starting at 250 to maybe 350 depending on the area, the demographic, the condition of the property. We're going to say about 300 here just to be conservative, times 143 units. We got 42,900. Okay. Let's see here. So we got repairs and maintenance, right? Let's just highlight that. And then we have our total repairs and maintenance. Okay. 8388, so 8389, 8389. Scroll back over. We got our make readies. Make readies, we can kind of add that into our turnover. Okay. So this would be our turnover bill. Okay, 95, 350, 603. Let's go ahead and change that to turnover. So what I did was come over to P&L, kind of come to other, just change the title, turnover. Oh my goodness. All right. And now it reflects here. Let's go back again, get that figure, 95, 356. 95, 356. Okay. We have common area amenities. Okay, we will come back to this. Let's highlight that as a come back to. Okay. All right. We'll come back to that. Let's do our contract services though. This is all the contract services that's on the property, and anytime we take over a property, we definitely want to reach out to all the vendors, start getting quotes from other vendors to see if that's an area that we can get better in. 46,215, 46,216, 46,216 contract services. Now we have utilities. You want to be able to break the utilities down. So we will add our electrics together. Okay. And then we'll put all our water, sewage, and trash together. So electric is going to be those two numbers added together, 20,295.87 plus 57, 66, 62, 26,062.49. 26,062. I'm sorry, 26,062. All right, and then we're gonna scroll back over here. We have solid waste. Add those three together and put them in the same line item. So we got 1910. You have to have a lot of patience with this stuff, ladies and gentlemen. 10 plus 11, 1906. Tell you what, I got to get a better calculator. Let me start this over. 1910, 50, 11, 19, 06 28 273 39 plus 15 398. I got 57,501. 57,501. We're going to go into our P&L and relabel this water, sewer, trash. Now it reflects. Okay, now we're moving on. We're getting somewhere. We got advertising and promotion. Okay, so let's highlight him. We may even want to come back to him. So we'll just keep him orange for now. Okay, office expenses. You can probably add the total office expenses along with the general and administration, the G&A, together. Okay, so we got 19,099, 19,099, 63 plus 40, 94, 98, 23, 195, 23, 195. All right, we got management fee, right? So we got total management fee here. It's 43,548. 43,548. Let me see here. We got property taxes, total property taxes here. 145,309, 145, round up a little. And we have some insurance, of course. So we got total property insurance, 41,404. 41,404. Okay, so remember the trash is down here now, so we're not going to have an expense there. There's no gas expense. Legal, there's probably some legal expense here. It's probably mixed in. Let me see, eviction fees. So if you wanted to, you can carve this number out, which is 2165, right? And just deduct 2165 from your total GA cost. And put the eviction fees in there. So maybe we'll just do that right now. So we'll just put legal 2165, which isn't much in this particular case, and we'll take the 23,195 minus 2165, 21,030. So we'll make a little adjustment there. All right, so they're reporting 55 expenses. This is, we want to stay there. And so your normal rule of thumb when you're underwriting deals, if this number falls well below 50%, like let's just say they're reporting 30% expenses or 20% or 17% or even 40%, you know that that expense ratio is a little too low for our normal standard rule of thumb when underwriting deals. We want to stay conservative. So let's just say, for instance, here, if this would have been 25%, then this, our my version column is going to factor it in at 50%. So as you see, we already have 10% in here. So we're just going to leave that as is. And now we're going to come down and really just try to gauge and really figure out, how much would they be asking. I'm thinking this would be trading around maybe a 5 cap. So what we're going to do, we're going to change this to a 5 cap. How do I know that? Simply because I've underwritten a ton of deals in this particular area. I've reached out to brokers about this particular area already to kind of gauge and get an idea of what properties are trading for. And so that's how we would figure out that value. So we would put 12,845. Let's go ahead and highlight this. Matter of fact, we have one more expense too that we need to do, which was our advertising and promotion. And so I'm going to actually add that into our contract services. Okay. And then I'm going to relabel that. So let me do that. Let's go back over here. Scroll back up to the orange, advertising and promotion. Scroll down a little bit to get the total on that. And it's highlighted here. Keep our eyes intact. So we got 16,306.76 plus. Okay, so we got 1606. Okay, let me go back again. 16,306.70. 16,306.76 plus 46,216. 46,216. 62,523. And we're going to go back to our P&L and add advertising plus advertising. Okay. Get a little bit more drilled down there. So we're at 56% expenses. I still think it's going to trade at a 5 cap. So we're going to go and put this number now. This is what the perceived value may be. So anytime they don't give you an asking price and it's to be determined by the market, simply what you have to do, you have to figure out what the net operating income is by taking your income, right, minus your expenses, okay, to get your net operating income. Then you would take your net operating income, right, and you would divide that number, okay, by 5%. So if I take this number, right, and if you're doing this on your calculator and I divide that by 5%, I should get my price or what the perceived value may be, okay, which is here, 12,518, right? And that's what I got on my calculator. So 12,518,942. When come and put that in, 12,518,942. Okay. So it's roughly about 87 per unit. We got to add in our repairs and our reserves. Our repairs and our reserves is a calculation that we computed when we were doing our CapEx, when we were looking at the OM. So as you see, that went from red to green. We got to make sure that we factor that in there because that's all the funds that we need to raise to come to the table. So right now, the total member capital needed to close is roughly about 4.8. All right, but we're knowing that this price is going to change here. So we got our cap rate at 5%. Let's just highlight that. Cash on cash return is fairly low with these numbers with a debt coverage ratio of 1.03. So this wouldn't qualify. But before we get into that, we're going to get a little bit more conservative here and say, well, you know, at 5% cap, Mr. Broker, it's not worth 12.5. We think it's worth 11.681. So our software is so smart, it gives us what we need to be paying based on how the property is operating, of course, with the T12. So 11.681,214, that's what we want to put here. 11.1,214. And we do that same for our offer column, 11.681,214. Now our offer column is going to be composed of the T12 expense, right, plus the current rent roll income, right, equals now our offer, okay. All right, we're going to just head over to our offer column now and put whatever the current rent roll is reporting. So we've conquered the T12 at this point. And so we have market rent, right? And we want to pay attention, okay, to the rent here. All right, so this is what they're charging, right? Okay, for market rent. This is what they're actually getting, okay? All right, again, this is what they're charging, okay? This is what they're getting, okay? All right, so let me see here. We want to add up these numbers, right? So gross possible, I want to just follow this all the way down to the end of the sheet. see what our total number is for the month as far as gross possible. Okay, we're not going to take into account, you know, the money they're getting for trash and none of that. That doesn't have to do with the rent payment. Those are additional charges. We want to focus on the gross possible rent. So keep scrolling down. 143 units. Of course, you're going to have a couple pages of rent rolls. It's not an Excel sheet. So our gross possible, you see, is much different than what our actual market rent may be, right? Okay, so gross possible, okay, is 117. Okay, gross possible. Let me see lease charges. Let me see actual potential charges. Okay, so 117, 344. And then we're just going to annualize that number. That's 1408. Okay, so it's actually lower. So this is just annualized, right? Okay, average rent is actually lower than what it should be. We'll leave our normal standard rule of thumb there at 10% for vacancy. We'll just kind of leave everything else the same. Now what we're going to do, we're going to come over to our summary column, our summary tab. So we have these different tabs: scenarios, 10-minute offer, summary, P&L, acquisition, exit strategies, returns, IRR, loans, first mortgage, so forth and so on. Okay, I'm going to blow this up a little bit. Okay, now with our summary tab, they're saying that we're at a negative 14% based on this offer price, right? Now, one thing we haven't done that we have to take into consideration, this is a value add, right? So we have to factor some of that upside into the P&L so we can get a more accurate number of, what our returns would be once we actually start implementing the business plan. And so we have to take that into account. Now, also what we want to take a look at, let me just kind of go through the summary here. So we got 143 units asking price, right? That's much different than what our purchase price is thus far. This may not even be our final number. We're still twerking it. We have 1% down. 1% earnest money, 25% down. This is what our first mortgage would look like at a 5% interest rate. Stay conservative there. We think with the agency loan, we could be somewhere in between 4.75 to 4.85. So we'll stay conservative at 5. On a 30-year AM, there's no second mortgage. There's no interest rate for a second mortgage because we don't have a second mortgage. Our acquisition fee is 3%. Closing cost is 3.1%. So this is what we attain once we actually close on the property. Here is the repairs and reserves that we factored in. This is the total member capital needed to close, plus the closing costs, plus syndication fees, the whole nine. And so you'll get here, we came over to the acquisition tab. Has all the legal fees, the property inspection costs, lead and paint inspection, all the due diligence costs that you have to come up with upfront, along with closing costs that are actually already added into the repair, are also added into what we need to bring to the table. So as you see, we have all these fees here. That accumulates to 485. So we come back over to summary and we'll see that 485 right here, what we need to bring to the table to close. Now you see our cap rate at resale. And I want you to scroll down here and take a look at our cap rate at purchase under key indicators, which is roughly about 5%. So usually when we're reselling a property, we want to be somewhere in between maybe 50 to 125 basis points higher. So obviously this is way more than 125 basis points higher. This is more kind of like 300 basis points higher. So we want to bring this down a notch to get a more accurate reading of what our average annual return would be over the life of the investment if we were to sell at so we got a 5 cap. Let's just say at a 5.75, being a little conservative, and that drops our returns down, or increase our returns to still negative, but it increased it. So anytime you have lower cap rate, you have higher values, higher cap rate, lower value. Okay, so we know that that's still not going to work, right? Okay, so now what we got to do, we got to kind of come back over here to our scenario offer. Remember what our pro forma rent was when we calculated that, which was 1,758,900. Okay, and that's what they're saying we can boost it to. Still, we want to be able to get a confirmation. Let's say here 5%. Let's just stay 5% there too as well. Want to get a confirmation from our property manager, right? And so they're saying that we could take it from 821 to 1,025. That's 143 units. So let's come in here and factor some of that into our P&L. And come back over to scenarios. We're at 1,025. Okay. So I think that we can do this by year 3 or the end of year 3. So this is the end of year 1, end of year 2, end of year 3. 143 unit reposition. We can do it by the end of year 3. I'd say by year 2, we can get this puppy up to say 925. Okay. And then we're going to decrease this somewhat and stay conservative still, right? And then we're going to stay maybe at 2% here, and then we'll get better here, and we'll just stay at 2%. So we'll factor that in. Now, one thing I do take from the OM, or at least try to gauge off of the offering memorandum, is what would the taxes be in year 2 once it's been reassessed. So let's take a look at that and see what they have as the reassessment in taxes here. Year 2. So we're talking about 141 in taxes. Add that 44 onto it. So what generally how you figure that out is you take roughly about 80% of the value that you're going to be paying for the property, which would be, come over to summary, which would be 11,681. Okay. Before we talk about that, you see how it increased our returns quite a bit, right? Once we factored in the upside. So we went from a negative to what? Almost a 12% return. But it still doesn't meet any of our metrics here, simply because the cash on cash return is very low. We want to be somewhere in between 8 to 12%. We will accept 7.5%. And then you want to make sure that it hits all of our metrics. So we stayed pretty good there with expenses. Maybe we can get better there with expenses too. So let's go back over to scenario. And let's bring this down to maybe closer to 50, maybe 52%. Let's see. We're about 1,400 a unit. I think this is rather high for payroll. So let's bring this down to about maybe 125,000. See what that can do for us. Okay, let's stay there at 53%. Right, that's close enough. Right, and so that should change our numbers here too as well. And that went up. So we're still good with expenses. So that means that this is where we would have to be at in order to make this work. But guess what? We still can't qualify for financing because 1.25 and our cash on cash returns are still freaking horrible. So what we have to do is do maybe like an interest only type product for 36 months. We'll blow this up, kind of see what it looks like if we're not paying any interest in the first 3 years. Maybe that will increase our cash on cash returns. It did. But not by much. It still doesn't boost it up. But what it did is it gave us our debt coverage ratio in the first year of a 1.49, which is pretty cool. But our cash on cash return is a little low. Okay. So let's say that we come in and bring 20% to the table, which would increase our cash on cash return. So let's go back up here. Say we're going to put 20% down. I honestly don't feel comfortable in today's market putting 20% down. We don't want to be over leveraged. We want to put anywhere between 25 to 35% down. But let's just take a look to see how that may improve. And it didn't improve our cash on cash return by much. It did drop our debt coverage ratio quite a bit because we put more money or put less money down. So let's go back over here and increase that. And you'll see our debt coverage ratio go back up a little bit. Okay, 1.49. Average annual return looks good, but our cash on cash return is a little skeptical. And the reason why you want to make sure that all your metrics are hit here is simply because if there's a sort of correction in the market, then we have cushion to play with. You just never know. You can't look into a crystal ball and say, oh, that's a good deal or whatever. So this is where we would have to be. To be honest with you, we couldn't be no more than 11,681. Now let's just kind of play around with this here for a second. Let's go over the exit strategies. Let's say that after we've repositioned the property, we got the property up to market rents. By year 3, we want to refi. Okay, and now we're returning. Once we refi, we're returning 91% of the initial investment back to investors. This is our capital account balance after return the money to investors, right? Okay, our interest rate may be a little higher. It's a refi, so let's factor that in there. Okay, let's go back over the summary. You see we're purchasing at a 5.6 now, right? So of course we gotta jump that up some. Let's say that we're gonna exit at maybe a 6.2. Okay, and that's more of a realistic return, but it drops our cash on cash return down. This deal is just not going to work. It doesn't meet our metric. I mean, even though the returns are decent here on a refi, let's see something here. What we never want to, underwrite the deal and try to get the numbers to work based on the refi. If a refi is just icing on the cake, we want to make the numbers work without a refi, because if we get into a deal and we're basing our projections on a refi, what if the refi doesn't work? What if there's a downturn in the market and then we can't refi out into a better term, into a better loan, simply because the market has corrected and now we can't finance, we can't get the proper financing we need. So got to take that into account. Let's go back over here. Then we had a 14%. This is if we liquidate in year 7. So go out to about 7 years. This is what the proceeds would look like. Net proceeds, profit paid to members, 2.758. Cash on cash returns a little lower than what we expected, but we should still be able to make profit there. This is what's paid to the manager after 7 years, which would be the syndicator. Okay, let's take a look at the P&L. Take a look at some of the cash flow here. What we didn't factor in is the new tax bill. So this will probably kill the deal because I forgot to add that in. So we're at, let's see what we're at here. We're at 11,681, 14 times 80% of the value, 93444 times 20.1. Okay, and so we possibly be looking at 193,000 in a new tax bill. Okay, simply because when the owner bought the property, he probably bought it years ago, and the taxes were assessed on the purchase price he paid. But again, now we're paying a much higher price than more than likely he paid. So our new tax value has to be assessed differently. Okay. So let's say, yeah, that's our new tax bill. Now let's come over to summary. Take a look at what we have now. Okay, well, I mean, it played with our returns a little bit there. And we can also boost the returns to members by, taking more of a less equity split. Okay. And so that will make this deal an 80-20. Let's see what a 75-25 looks like. Okay, so they're above 12.5%, but our cash and cash returns are still low. But everything else looks pretty fair. Okay, and so I want to come here and just kind of see how the cash flow plays out. This is how the cash flow plays out. As you see, for the first year, the members are receiving 145,000. The manager syndicators receiving near 70,000 in the first year. Those numbers increase all the way until we get to the fourth year. It drops down in the fourth year. Do you have a reason why? Or do you know the reason why? The reason why is because we're on an interest only, right? And so now we start paying on the principal in year 4. So our cash flow is going to drop down a little bit here. They allowed us to now get the property up to market rent, so forth and so on. So that's pretty cool. Let's take a look at the returns tab. Okay, so we base this off of liquidation in year 7. So this is our beginning member capital account balance that we needed to bring to the table. Remember, this is the cash flow for the members year 1, year 2, year 3, year 4. Here's the cash on cash return. As you see, as we start, it goes up dramatically once we get it up to market rents in year 3. And then it takes a dip back down simply because we have that interest only that we need to pay for. Okay, here's the member. The manager, the syndicator. This is what they're receiving year 1, $420,000. The reason why this number is so big because we get the acquisition fee in year 1 plus the distribution plus the asset management fee. So we do have working capital to keep working, bringing people in to help grow the organization. And so this would be part of our working capital here. And then this would be our layout for year 2, year 3, year 4, year 5, year 6, year 7. And so as you see, one of these deals could be life-changing, just life-changing, man. And this is just the power of multifamily. And you consider yourself financial free at this point. You should be able to take care of all your household bills in between 5-10,000 a month. You should be free. So that's pretty cool. I think that's enough for this particular deal right here. This is probably a deal that we're going to end up submitting an LOI on, right? We do like these returns. I'm preaching to our guys that that they should be expecting anywhere between a 10 to 13% average annual return over the life of the investment. If there's an opportunity to have a liquidation, and return some of the capital, we would definitely do that. We definitely have the opportunity to do that in year 3. We're returning 60%, okay, which is good, but it drops our average cash on cash return down quite a bit. Why? Because we've given most of the cash back at this point. So let's go over the returns and just kind of take a look and how that plays out. Okay, and it's on an interest only, of course. So now we have to start paying on the principal in year 4, right? And so that's the only way this deal will work is an interest only loan. In this particular case, I don't think that we should take cash out in refi. We don't want to be over leveraged there. I would just do this on a straight liquidation, to be quite honest with you. That's how I would plan this out, unless we just over exceed expectations, and then we figure out at that time whether it would be worthy to refi and give some of the members their capital back. So we'll keep it based on a 7-year business plan. Okay, almost 13% returns. We can boost that, or if you say we want to get more returns and take a less of an acquisition fee, we'll take 2%. We can boost returns that way. So we'll take a 2% acquisition fee, right, to boost the returns, give them more than what their money bargains for. Okay, and I think this is what we'll actually submit here, and so we'll blue that up. We'll blue that up, right? Because that's what we're going to create an LOI on. So that is it for today's training. Stay tuned for the next training for another deal that we're going to be underwriting.